Hi all, Ray here from Switch Finance. I've got a couple of our brokers here. We've got Eghart, Mike and Josh. We thought it timely just have a bit of a discussion about what's happening in the market as far as interest rates go. I think there's a lot of anxiety out there, and it's always good to have a discussion around these and make sure people are prepared for what may be coming. As we all know, we don't have a crystal ball. There's a lot of talk that rates are going to keep going up this year and could get as high as 5%. We don't know that, but what we do know is it's important to be prepared and have yourself in a strong position going forward. What are your thoughts, guys?
I think it's important to put it in perspective in that for the last 10 years we've had only declining interest rates. This is the first time in 10, 11 years we're going to see interest rates go up. So a large number of people would never have experienced that. So it is a new experience. The other thing, just to put it in perspective, rising interest rates are not necessarily a bad thing. It means the economy is reasonably strong. I know now it's currently to do with maintaining or try and retain inflation, but ultimately it shows a strength in the market, and the interest rates that we had up till now were artificially low, and it cannot be sustained, and it was not realistic to expect to remain at these levels. So it will go up, and people need to be prepared for that. But I think the important thing that you've already mentioned, it's not necessarily the end of the world. You just need to make sure that your finances are in a good place.
You get that initial anxiety of they're very used to the last 2 years of low interest rates, property prices constantly increasing, and now we're having that discussion around what your repayments may look like over the next couple of years, and whether that property purchase is going to maintain. If you were to buy 6 months ago, are you going to be looking at negative equity over the next couple of years? So it's more about assessing the individual, bringing them a little bit of comfort of the initial structure we've put in place, or how we may look to attack things a little more conservatively moving forward.
Is it worthwhile fixing now?
That's a very good question. That's a question we get very often. There are a couple of reasons why you should look at a fixed rate, and it's often not. I think the most important thing when you look at fixed rate is, why do you want to have a fixed rate? If it's to do with certainty, then absolutely consider it. But if you're trying to do it to try and beat the interest rate market, I don't think that's necessarily the right thing to do.
It's impossible.
And I agree with you, Ray. I think that bus has gone, the train has gone. You've got fixed rates now of 4.5%, so they're already 2% higher than what your variable rate is. So if you just think it through for a moment, if you take a 3-year fixed rate at, say, or 4-year rate at 4.5%, for a certain period you're going to pay 2% more than you would have paid otherwise. So really, for it to make financial sense, at the end of that period, the rate's got to be probably about 2% above the 4.5 to break even.
You're actually almost gambling. You're betting that the rates are going to go up faster than they may.
Correct.
If they do go up really quick and you fixed it 5 years at say 4.7%, then you're a genius.
Yeah.
But if it takes 3 years to get to that point, then you've paid a lot of extra interest for no reason. But as you said, if people ask me, I say, look, if fluctuating interest rates are going to scare you and hurt you, then by all means you need to consider a fixed rate, even if it is going to be a fair bit higher than the current variable. So it's all depends on your risk appetite. What about you, Mike? You deal with a lot of business owners. What's their feedback on what's happening with interest rates at the moment?
I think part of it is it was inevitable. It couldn't get any lower than it was.
Couldn't.
And now the market's turning. It's caused a bit of undue panic that it could only go up. You mentioned fixed rates there. A couple of clients who've been very interested in that, and that's been around choice. Yeah, they know the rate was 1.25 higher, but they've chosen to go with that for that stability. Which is fine. There was no convincing from my part on which way to go. That's what they wanted, and that's what they took.
I think the other thing with fixed rates important is that when you fix, you don't have to fix your whole mortgage. You can split your loan. You can say fix half and keep the other half variable, which just gives you a little bit more flexibility in terms of whatever your aim is in terms of fixing or not.
So hedge your bet, so to speak.
Correct.
Because I suppose with fixed, you don't have, with most lenders, you don't have that same flexibility of offset or paying extra lump sums and redrawing. Some lenders do, but very few. But yeah, having some variable and some fixed gives you the best of both worlds, I suppose. Yeah, but most importantly, I think if you're worried, get a review done. Something really important that I do for my investor clients, I make sure that they have a buffer in place for every investment property around 20 grand. So if someone had 3 investment properties, I would try to ensure they have a $60,000 buffer. And what that does, I suppose it gives them a bit of comfort to know that that's there, but you can weather the storms that come. You should never be so lean that if interest rates go up, your whole portfolio is in jeopardy and you've got to start selling properties under duress. And you know what happens when you do that? You take a hit. Whereas if you've got that buffer there to rely on, you can take your time and reassess your situation and hold your position comfortably. So make sure that you are in a robust position, get a full review of your current financial situation, and then make sure you put in a comfortable position moving forward.
When a bank assess a loan, they don't assess it at the rate that you currently pay. So let's say you currently at a variable of say 2.5%. The rate that they assess it at is 5.5%. So they've got a 3% buffer that they actually determine whether you've got the capacity to actually repay the loan. At the end of the day, you still got to manage your own finances. You can't go back to the bank and say, "Oh, you told me I can survive."
Absolutely.
But it should give people some comfort that the bank has assessed and said you just might need to make some minor adjustments to your living expenditure to be able to.
It's a really good point, I didn't even think about that. Yeah. So very good point. They have already factored in a 3% buffer on the interest rate that people currently have or have applied for. So don't panic. That's the number one thing. Don't panic. There is a buffer in there. You will be able to weather some interest rate rises, unless, we go back to 1988 when Paul Keating had interest rates as high as 17 and 18%. That's a different story. But I just thought it'd be good to throw up a slide, show the viewers what in real dollar terms these interest rate rises may mean to you. And I've done some just based on a $500,000 mortgage. What does it really mean, a rise in interest rates? So we're looking at an average loan size, I suppose, of $500,000 on a 30-year term. So if you're lucky enough to have a great rate, a current rate of 1.99%, your monthly repayment's going to be $18.46 a month. Now, if that jumps to 2.5, it's basically going up. It's going to cost you $30 a week more. Nothing too stressful there. And we'll take it up to 3%. Now we've added $60 a week to your existing or to your original repayment. 3.5 brings up an extra $92 a week. 4. You're over 125 a week, starting to get a little bit more serious now. 4.5%, you're almost $160 a week you need to find. At 5%, you're now thinking of giving up the smokes to pay the difference in the mortgage repayments. 5.5, $229 a week, and 6% will add $266 a week to what you may currently be paying. I just wanted to point out that means we've had, to get to 6%, we've had 0.25% rate rises from the RBA. But that doesn't necessarily mean that, because the banks don't have to follow the RBA. Right. Just because the RBA goes up 25 basis points, the bank could choose to go up 30 points. If their funding costs have increased, they may go up 35 points.
So, Ray, that's very interesting. And I mean, obviously, we're just showing clients here what might happen at various levels of interest rate, hypothetically. But if we look at what the major banks, the big banks are saying as to what the expectations are, and that's confirmed with the view of the RBA, they expect rates to probably peak at 2.5%. That's the cash rate.
Yeah.
So that's going from now a little bit over 2% from where it is at the moment, sort of 2.25%. That's their aim. And obviously, if that happens, then you're sitting at 4% roughly in terms of interest rates to the market,
retail
4.5%.
rates,
And that's probably a more realistic sort of expectation. If it goes to 6%, that means something's gone wrong. Inflation has really got out of control. And hopefully that'll be sort of at that middle range, at that sort of 4%, 4.5% for the average punter when they...
No, I think, thanks for that, Egard. I think that will take away a little bit of anxiety from people. We've shown what it will do up to 6%. We don't believe it'll go there, but it's always good to know what lies ahead. But I agree with you. I think 4% is probably where they are going to aim, at least for the next 12 to 18 months anyway, and they'll review it then. As always, guys, if you have any questions at all, any concerns, get in touch, have a review, or just a chat on the phone with any of the brokers. We're here to help.